Okay. Hello.
Hello, how are you?
Good, thank you. Okay, so I think we're waiting for one more person.
Kim will be on in a minute. I had to send her the link.
Okie dokie. I thought I resent it to everybody just in case, but I guess that didn't go through. Oh, share screen. Okay. Okay, are we all ready to get started?
Yep.
Yep, we are.
Okay, great. Welcome on board. My name is Gloria Benarash, and I'm a full-time realtor and an instructor. And a broker, right? I'm a broker. I have to be a broker before I could be an instructor. Sorry. Okay, so I understand that Frank wants me to go over with you on chapter 15, and then also deeds. And then I'll also be doing Wednesday with you, and I will be doing chapter 1 and 2 with you on Wednesday. So it's my understanding from Mariama, I think it is, that you guys start at 6.
Yep. We start at 6.
Was that a yes at 6 p.m.?
Yep, at 6.
All right, so then on Wednesday, I won't be here at 5:30. I'll be here at 6 p.m. All right, so let's get started, and let's just see where we are. Okay, so you've basically gone over what the mortgages are, and the different types of mortgages. So now we're going to be talking about the secondary market. Okay, and the secondary market is more for the banks. All right, because the banks have to have certain requirements on hand, and if they don't, then they have to turn around and sell off some of their loans that they've made so that they can have enough monies and then again, start lending monies out there. So the first thing that we're going to talk about is a purchase money mortgage. Usually this is called when it's a seller's financing it, okay? Or it could be a first or second mortgage, but a purchase money mortgage is when the seller finances it. A reverse mortgage, on the other hand, is typically used for senior citizens, and I don't mean like 60-year-old senior citizens. I'm talking like 70 and 80. They have a lot of equity in their property, and they really don't want to move to an assisted living or another place. So one of their options is to be able to do a reverse mortgage where they pull out the equity from their property so that they can get a monthly income and stay in their house. So it's called a reverse mortgage. It's based on the equity that's in the house. It is based on FHA guidelines. And then therefore it allows, in this case, the senior citizen to stay in the house instead of going into a senior citizen's house or assisted living. The other thing too is what happens with the reverse mortgage is that it could potentially become negative amortization, and negative amortization is basically where the interest rates compound on the backside, and it grows and grows and grows. This mortgage could be a growing mortgage. A lot of times with the senior citizens in their 70s, 80s, and 90s, that does happen. But when they do pass away, the bank can only accept what the market value is of that property. So if the dollars, the reverse mortgage is higher than the what the market value is, they will have to accept the market value. A home, okay, so that's reverse mortgage, okay? A shared equity is also known as a SAM, or it could be known as an SAM, or it could be known as an SEM. So SEM is shared equity mortgage, and SAM is shared appreciation mortgage. They are both the same thing. And basically what it is that the bank feels that this particular item that somebody came to them might be worth investing in. So what they'll do is they'll give a lower percentage rate. And then when it's time to turn around, and it's typically in a development, it's something big, it's not a small item. And so then this way they will, when it's time to sell the property or the items that they're selling, then they will share in the profits of that particular project. So that's an SEM or an SAM, shared appreciation or shared equity, basically means the same thing. A package mortgage, that typically is used in new construction. And what it is, it's including real property and personal property. It's typically used when we're financing furnished condominium units. So if you're selling a condominium along with the furniture in it, you would basically have a package mortgage, okay? Pretty simplistic. A blanket mortgage is typically used on new construction. It's typically used when the builder has subdivided the property, right? And so let's just say the builder has purchased a farmland, okay? And now he has subdivided that farmland into, let's call it 15 lots, all right? And he mortgaged the property. So basically now we have 15 lots with a mortgage over all of the property. So what happens is now he's sold one of the lots off to somebody and he built the house. And basically it's like a blanket. So this particular mortgage, in order for him to sell the property and give the deed and the title to the new buyer, he has to lift the mortgage off of that lot. He has to release the mortgage on that lot, sell it to the buyer. He then gets paid, obviously, from the buyer, and then he'll pay off part of the mortgage, and then it'll continue on down the line on all the different lots that he's selling off. All right, so that's what a blanket mortgage is. A wraparound mortgage is when the buyer is going to retain the mortgage. Oh, I don't have it here. Where did it go? I don't have the explanation. Sorry. Okay. So a wraparound mortgage is when the buyer is going to keep the seller's original mortgage. All right. Because for whatever reason, it's a really great, nowadays we don't have that much because our mortgage interest right now is so low. So, we don't necessarily get into that. But basically what it is they're going to keep the seller's original mortgage, and then they're going to take the remaining what they owe the seller and get a new mortgage. Okay, so that particular amount will be at a higher price. And so basically what happens is they pay the seller what his mortgage is, and then the seller pays the bank. All right. The key with this is one has to be extremely careful, because if the seller doesn't pay the mortgage company, then the buyer could potentially lose the property because it might go into foreclosure. So it's a little tricky, and you just, obviously with everything, you need to get a lawyer to make sure everything is written up properly. So that is basically a wraparound mortgage. An open-end mortgage is where you can borrow monies where you could borrow monies on top of the mortgage that you already have, but you must have paid it off to a certain extent before you can get the money. So it's getting additional monies it's usually for improvement. So usually it's to fix a property, and if you're going for it, they have to give you the funds. That's basically an open-end mortgage. So you borrow money, you pay it off, you borrow money, you pay it off, you borrow money, you pay it off. So it's kind of like a credit card. It's just that you're using your house and your mortgage as security for that. A construction loan is typically used for new construction, and it's typically a builder, or if you're going to be building your own house, you would be getting a construction loan. It usually carries a higher interest rate. It's typically just for 6 months. It could be 9 months. It's short term, and basically what you're paying is the interest rate on it. You're not paying principal and interest. You're only paying interest on it, because once you're finished with the new construction, once your house is built, then you will be refinancing it into a regular mortgage. The way a construction loan works is if you're the buyer and you have a builder doing it, then basically the builder will get 3 drafts. They have to build it up to a certain point, then the bank will come out and inspect it, and then they'll allow to give them a payment, and then they'll get to another point, and then the bank will come out and have it inspected, and then the builder will get paid again, and then they have to finish it up, and then at the very end they'll get paid. So it's usually 3 drafts that they get, and then after that, the buyer, the owner, is going to refinance it into a regular standard mortgage. Okay, so that's that. Then we have a sale leaseback arrangement. So a sale leaseback arrangement is typically when an owner has a commercial property, and they may or may not have, they usually would have a retail shop or some sort of business on their commercial property, and they are looking for a cash influx because they need cash for their business. So what happens is that they are going to try to sell it to an investor, and then and the investor has to know and understand that if they purchase that property, that the original owner can stay on that property and lease from the investor who purchased his property. So this way it frees, and especially if there's a lot of equity in the property, the original owner, will probably want to cash out that equity so that they can continue on with their business and put an influx more money into the business. So that is what a sale leaseback is. So it's basically commercial. Typically, it's commercial property. They're going to sell it to get more money or to get the equity out of their property, and then they're going to lease that property back from the new owner. Are we all good with that? Any questions?
Nope.
Nope. Okay. All right. And if I go too fast, let me know. Okay. Just so that, I don't want you to, anyway. Okay. So seller financing is also known as land contracts. And that the land contract word is what they're going to use in the state exam, not necessarily seller financing. So you should know that. Basically, the buyer is going to receive the deed to the property, but they are agreeing to make payments to the seller, not the lender. Okay, and then once they've paid off all of the payments, only then will they get the title to the property. So the deed is basically an acknowledgement that the seller is willing and has agreed to transfer the property to the buyer, but the buyer and the seller still keeps the title, meaning they still keep possession in writing of the property, okay? And then when the buyer pays off the financing or pays off the amount that they owe them, then the buyer will get the title to the property, which will then show ownership as his. He now, or he or she owns the property. Okay, so all they're getting in seller financing is a deed. Okay, and then once it's paid off, will they get a title? And that's very important to remember. The other reason you want to remember that as well is because the buyer will probably need to get a title insurance on the property to make sure that the monies that they're paying the seller is going towards the mortgage. And then this will safeguard that nothing happens to the title, that the bank doesn't take over the title, and then they're SOL, having paid the seller this monies, and they know they are not able to own. A lease option or a lease purchase, okay, is basically what is known as a unilateral contract. So what is a unilateral contract? What is a regular contract? Anyone willing to guess?
I'm just flipping back to review.
Okay.
Unilateral is a one-sided agreement.
Exactly. And a regular contract is?
Both parties promise to do something.
Exactly. All right. And the uni means one. So that's why it's a unilateral. So basically what it is typically the buyers agree with the seller with a binding contract that they would like to buy the property. Okay. And so it's been agreed upon. The buyers, because it's an option, okay, they are the ones that exercise their option. So it's one-sided. They're the ones that can exercise their option. And what that means is they can say that, yes, they will buy it, or no, that they will not buy it. And if the seller decides that he doesn't want to sell it, but they want to buy it, the seller is forced into selling that property. Okay, it's not to the seller's advantage, because again, if the market changes and the market starts going up and they agreed at a price that's way lower than what the market is a year later, again, it's not in the seller's interest. Also, the other reason it's not in the seller's interest is because they will have lived in that property and they may have destroyed the property or, done things to the property, and then they could choose not to exercise their option. And here, a year later, now the seller has a property that's been lived in, quote, destroyed, let's just say, and he's back, and the seller is back to square one. A lease option, a lot of times, is done in when the interest rates are extremely high and they can't sell the property. Currently, nowadays, in our markets that we have right now, lease options are, unless somebody's in trouble, whether it's the seller's in trouble, if the seller's in trouble or something, I would presume that would be the only time that they would do it, because the market rate, the value of the properties are going up, they're not going down. So those are lease options or lease purchases. They are known as unilateral contracts. Okay, so it's a one-sided contract. Okay, and then we already talked about a sale leaseback. Any questions?
Nope.
All right. So we're now going to be talking about the primary mortgage market, and then we're going to go into the secondary. So the primary mortgage market is basically where we, the buyers of a property, go talk to a mortgage broker, banker, savings and loan, credit union, and we apply to get a mortgage. That is the primary market. Okay, so they'll in the state exam, they might ask you who the institutional lenders are. So in this case, it would be savings and loan, credit unions, mortgage brokers, mortgage bankers, life insurance, mutual savings banks, and things of that nature. That's where the borrower or the buyer will go and apply to purchase to get a mortgage to be able to purchase the house. Okay, and then basically at this point in time, these lenders, depending on what kind of a mortgage you need, you might need an FHA loan, or if you're a veteran, you might go for a VA loan, or if you have money, 20% down, then you might want to go for a conventional loan. But all of this is done on the primary market. All right, so what you do need to know is, what is the difference between, let's see, do I have it in here or not? No. Okay. So what you do need to know is, you need to know the difference between a mortgage broker and a mortgage banker. Okay. While they both give monies, there is a distinct difference. So a mortgage banker, okay, uses their own money to fund the loan. Okay, so it's a mortgage banker uses their own money or their own funds to fund the loan that the borrower is going for. A mortgage broker, on the other hand, is basically going to go to a lot of investment people or banks or people that they know, and they're going to broker the deal, meaning they're going to try to put this deal together with somebody that they know or have an association with. So they are going to other people to get the money on your behalf. Typically, a person will be using a mortgage broker is because they have credit issues, or it's a business, or there's other issues that a standard mortgage banker is not going to lend to them. So that is the difference. So a mortgage banker uses their own funds, and a mortgage broker is going to shop your loan with other people's monies. That's the difference. The credit union is basically an organization that you have to belong to. Oh, he's just going to have to wait. You have to belong to the credit union, and typically when you do belong to the credit union, you can get a better rate than if you were to go out to a regular bank or or another company of savings and loan or another bank, and you can get better funds, better interest rate. Okay, so the application for credit. Basically, what you're going to do is the buyer's basically going to fill out an application fee, just like we fill out application fees left and right. They're going to be filling out the application fee. And based on that, then they're also going to have to supply the bank or whoever they're using, they have to supply them all the information, and it is paper driven. So they will have to supply all of the information to what's that word? I'm missing out the word. Anyway, to prove what they've put on the application. So they'll have to supply their tax returns. They might have to supply their bank statements, saving statements. If they have IRAs or 401ks, they'll have to supply that. If they're going to be selling off some of their stock or stating that they have assets and their stock is their assets. So basically anything and everything that has to do with their finances to prove that they are able to purchase this property or to be able to qualify for a mortgage, they're going to have to prove all of that via paperwork. All right. And one of the biggest things right now that's happening in the mortgage is that everything is dependent upon what they call a FICO score, which is the Fair Isaacs credit something or other. Let's see if I have it here. Well, it's Fair Isaacs and Company. So currently, the way things are going, you have to have at least a 600 FICO score or more. All right. Otherwise, anything below 600 is rather difficult to get a mortgage, unless you have no other debts or something like that. You've paid off a lot of things, but FICO scores are right now the biggest indicator whether you're going to be able to get a loan, whether you're going to be able to get a loan with a good interest rate, because you might be able to get a loan, but the interest rate may not be that great. Okay. So then what happens is once they've taken all this paperwork from you, then the processor, the loan processor, is actually going to verify everything that they've gotten in paperwork. And excuse me for 1 second. Okay, so so they'll have to verify the paperwork, and then what they're going to do is they're also going to wait for the appraisal of the property to make sure that the property does appraise based on the mortgage amount that they're going to that they're applying for. So all of that aspect of it is called underwriting. So the loan processor, when they're looking at all of the paperwork to prove the application and then the appraisal, that's what underwriting is about. So they're proving everything and making sure everything is right. And then after that, based on all of that, they'll decide whether they will grant the loan or not. Okay. So when we're talking with buyers, all right, we always say, well, we want a pre-qualified buyer or a pre-approved buyer. What that means, those are two different things. And I will tell you that seasoned agents half the time don't know the difference, or they forgot about the difference. Okay. And so let me explain that to you. A pre-qualification is basically me calling up the mortgage broker and saying, hey, my name is Gloria. I'm looking to buy a property. And the mortgage broker on the other side says, okay, Gloria, so how much do you make? Where do you work? How much credit debt do you have? Do you have any car payments? Do you have any credit card payments? Do you have any school payments? Do you have this? Do you have that? And so I basically verbally supply all that information. And the broker then will input that into the computer. And as with everything else nowadays, it's AI, artificial intelligence, and the artificial intelligence spits out and says and tells the broker what I am able to afford. And based on that information, then I will go look for a house. And once I found a house, I'm going to call the broker back and say, the mortgage guy back, and I'm going to say, can you please send me a pre-qualification letter? Can you send me a letter saying that I can afford this house? So basically what that means is the broker just took all that information based on what I said over the phone. Okay. So yes, based on the information that I gave that person, I am qualified to purchase this dollar amount house. But until it is actually verified, that does not necessarily mean that I am approved. All right. Now, a pre-approved individual or a pre-approved letter means that that individual has supplied all of the information, they verified all of the information, and they're just basically, the letter states that they are approved for a loan, and we're basically waiting for them to find the property and get an appraisal on the property. So that's a much stronger buyer. And typically that kind of a buyer is, especially nowadays in the market that we're in right now, because we're having a lot of bidding wars going on right now. So what happens is that the buyer may have started out with a pre-qualification. They went with the agent. They made offers on properties, and they lost on the properties. There's a winner and there's a loser, unfortunately, in a bidding war. And so then what happens is that the buyer then still continues forward with the application or the mortgage process. So then by that time, they've been in underwriting and everything. And towards the end, then they're approved, but now we're waiting for them to find a property that they get accepted on and to get an appraisal on that property. That's a perfect kind of buyer that you want. Now, my understanding, I don't know this factually 100%, but my understanding is now that there are some mortgage brokers that are actually going through a mini underwriting where they do ask for the buyer to send in some of their paperwork ahead of time so that they can get a real look and a real verification of the items that was told to them over the phone. And some banks are now, or brokers are now calling it a pre-approval letter. So one has to be kind of cautious about that. Just my answer is just, it's in your best interest as a realtor to be aware of the finances of your buyer, okay? And make sure that it's not somebody who had somebody help them write up a letter or something to that nature. If in doubt, if your gut tells you something is not right, then my answer to you is, if you are representing the buyer, then it is in your best interest and the buyer's best interest to make sure that the mortgage broker or banker, the letter that they gave you, that that it is exactly who that is, and that the funds or the dollars that they're saying they can afford, they can really afford. And as you go through the transaction, there will be a lot of times that you may need to speak to the bank or broker on your buyer's behalf, because there might be some issues. I currently just had a situation with a young lady where everything was perfect, everything was great and all of that. And lo and behold, with an FHA loan, okay, I don't understand the whole thing. It's a sad situation, but somehow FHA has a way to go back 10 years to see if there's any outstanding loans of any type. And in this case, my young lady had an outstanding school loan. And so as a result of that, that had put the kibosh on the mortgage. So now she's not able to get a mortgage for this particular house. So we had to back out of the contract. But again, if there's little tweaks or anything, you and the mortgage guy can talk about it. You and the buyer can talk about it. So sometimes you do get involved with the mortgage aspect of it. Are we okay?
Yep.
Okay. All right, good. So the last thing is, when you get the mortgage, what tells everyone that you have the mortgage, and that basically now at this point in time, it's a hurry up and wait situation. It's called the loan commitment. That is one of the most important things. So if you are helping a buyer, right? So the transaction is as follows, where we met with the buyer, they gave us a pre-qualification letter, we went and looked at some houses with the buyer, we found a house that they like, we make a contract offer, our offer is accepted, it goes into attorney review, and how many days is attorney review?
3
what?
3 business days.
Okay, you need to make sure you say 3 business days. You need to make sure that when you look it up on the exam, it's 3 business days, not 3 days or 3 calendar days. Very important, okay? People make mistakes like that. So 3 business days, we're out of, let's say it's actually 4 days at this point, we're out of attorney review. Then the buyer now has to make an application for a mortgage. They have to do it within 3 days, okay? So they've made the mortgage application, and typically when you write up the contract offer, you're going to write that you're going to expect a commitment letter from the mortgage person within 30 days, 35 days, whatever, so that doesn't fall on a weekend. That is one of the most important dates to make sure that it gets done. That's actually the second important date. The first important date is that the deposit, whatever deposit you stated that the buyer is going to do, you usually would put a date on there. And so that's the first important date, must be met, because if it is not met, it's then considered breach of contract. Okay, so if you don't meet the dates that you put on the contract, then that can be considered a breach of contract. So we put the second deposit date there. So that's the first important date. And the last most important date for the seller is the loan commitment date. And the loan commitment date basically says, okay, we have gone through Mr. and Mrs. blah, 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 and we have approved them for, the appraisal was done, and all we're doing now is waiting for the closing date and title and whatever. So basically that tells the seller that they've got the mortgage, and now it's just going to be hurry up and wait until the closing date and the other paperwork that needs to be done. All right. So that brings you to the loan commitment. And so now we're just on a hurry up and wait situation. FICO scores, I just told you about. They are the most important thing right now in order to get a mortgage. So the next thing that we also need to know about and understand and be able to explain sometimes is what they call a qualifying ratio. Oh, I need to get my board. All right. So a qualifying ratio, what is that? This is what the bankers or the AI uses to see if the person is qualified at all, if they're at all qualified for a mortgage based on their income. Okay, so let me get my board. Excuse me for one moment. Where's my board? Okay, sorry about that. All right, so what we're going to do is you can use your computer, your calculators, okay? So what they're trying to do is they're trying to figure out what the person makes, and are they able to afford the payment. So when we're talking about ratios, we're talking about a front ratio, which is 28%. And then we're talking about the back ratio, which is 36%. So if we were to take an individual who is making $5,000 a month, okay, because we're talking in monthly numbers, right? So we're going to take $5,000 a month, and we're going to multiply that by 28%. So 5,000. So that's $1,400. Okay. So that's $1,400. that amount has to be for the housing. Okay, so that's for the actual housing payment. That's the max amount that they are able to have as a housing payment. All right. Then we're going to take that $5,000 and we're going to multiply that by 36%. All right. So that gives us $1,800. That number, okay, so $1,800. So that number represents the housing payment of $1,400 plus an additional $400 to equal any of their long-term debts, okay? So that $400 has to include credit card debts, school debts, car payment debt, or whatever the case may be, all right? So basically their monthly nut, okay, is $1,800 based on a $5,000 a month income. All right. Now, what that is also known as, it's known as PITI. I don't know if you've gone through that. Okay, so PITI is P is principal, I is interest. Okay, so this $1,800 is basically principal and interest. I mean, the 1,400, forgive me. The 1,400 is principal and interest, okay? And then we have T for taxes and I for insurance. So when you're dealing with the buyer, they basically want to know what is their monthly rent or monthly mortgage payment, all right? So if you have a calculator, you can kind of figure out what it is. So let's just say we know that their monthly payment is $1,800, all right? Now to that, we're going to have to add the taxes. So you found a property and let's say the taxes are $12,000, right? So 12,000 divided by 12 is $1,000. So to the 1,800, we would add $1,000. And then let's just say they have, it's a condominium. So a condominium might have association fees. So let's say they have $200 association fees. And then they also have to have homeowners insurance. So let's say the homeowners insurance is $1,800 a year, divide that by 12. That would be $150 a month. So basically we are talking 8, 9, 10, 11. We're talking 11. So we're talking $3,150 a month. All right. So on $3,150 a month, based on whatever it is that we found for them. Okay, and that gives them an idea of what their monthly nut is. All right. Now, sometimes $400 truly is not a lot of money for debts or anything of that nature. So a lot of times people need to go look at another bank or another program where they could where it could be a little bit more lenient on the back end. So typically FHA is more lenient on the back end where they could potentially give up to 43% on the back end. So if we were to take 5,000 times 43%, okay, that would be 2,150. And if we minus the 1,400, okay, that would give them an additional $750 instead of the $400 originally. Okay, so qualifying ratios are important and they have to fall within that. Now, as you can see, FHA now goes as low as 620 and as low as, I mean, they want you to be higher than that. So anybody below a $600 FICO score is going to have a very difficult time in getting a mortgage, especially nowadays. Okay, so that's basically that. Are we good with that? Are there any questions regarding that?
Nope.
No. Okay. So that's basically as far as how you can figure out how you can figure out the monthly payments for a buyer. Because a lot of times, especially for first-time home buyers, they're always wanting to know what is their monthly payment. All right, so now the next thing that we're going to talk about is the government and mortgage lending. Well, we know about the FHA and we know about the VA programs. They are insured or guaranteed loan programs, and they're guaranteed or insured to the bank, not to the individual. They're to the bank. So the next kind of thing we have is what they call the secondary market. The secondary market is now where the banks, not the individuals, not the borrowers. Now it has to do with the banks or the investment people, whether it be an insurance company or anything other than the individual. They're the ones that will sell off the loans on the secondary market, because the banks must have a certain amount of liquidity. That is the law. They have to have a certain amount of liquidity. And if they've overstepped their liquidity, then they have to sell off their loans in order to become liquid again and again, so that they can go out and lend some more monies. So we have what I call I learned it as the three little pigs. All right. So it's Fannie Mae, Ginnie Mae, and Freddie Mac. So it's the Federal National Mortgage Association, which is Fannie Mae, and the Government National Mortgage Association is Ginnie Mae, and then we have Federal Home Loan Mortgage Corporation, that is Freddie Mac. Okay, so those are the governmental influences. Then we have, and these have certain certain systems that they belong into. Okay. Right. Okay. Loans that don't conform to certain underwriting standards, they're known as non-conforming loans. So if we're talking about a Fannie Mae, Ginnie Mae, or Freddie Mac loan, those are called conforming loans. They belong inside that little box, whatever that little box is. If they fit inside that box, then they would be able to be sold off on any one of these. A non-conforming is considered portfolio lenders, which means then it's the bank that's holding the loan. It's not a loan that's going to be able to be sold off on the secondary market. It's a loan that they're going to have to keep in-house. And usually it's a jumbo loan, or usually a loan that is in a portfolio is because there's an unusual credit situation, or it's a business situation, or the house is unique and none of these other lenders are going to take on this mortgage. So those are called non-conforming loans, and they are also known as jumbo loans. So why is this not going where I need it to go? All right, doesn't matter. We'll continue forward. So on page, if you guys are following in the book as best as you can, on page 258, okay, it gives you the definitions for Fannie Mae, Freddie Mac, and Ginnie Mae. The most important part for you to remember is Fannie Mae pretty much buys up all of the loans, okay? Conforming loans is the real word. So what you need to know about Fannie Mae is a shareholder-owned company, okay? It buys up most of the loans, and they sell stock, okay? So you can buy stock on the exchange. The Ginnie Mae, what you need to know is that it's primarily for low, moderate, and high risk mortgages. It sells, it gives you a pass-through certificate. So Ginnie Mae is also a corporation. It's moderate, low income, and high risk mortgages, and it gives you a pass-through certificate on a pool, okay, of mortgages. And then the last one is Freddie Mac. It's a shareholder corporation or company, and it is primarily for the savings and loans and conventional loans, and it sells bonds. Okay, so Freddie Mac is savings and loan mortgages, conventional loans, and it sells bonds on the open market. Okay, those are the three minuscule items you need to know about those individual items. Okay. So non-conforming loans, I told you, is a jumbo loan. For us, a jumbo loan, I know the numbers are changing, so I want to say anything above 800,000 is considered a jumbo loan. Now, I don't know when Frank was teaching you, did he tell you the new numbers for FHA and VA?
Did he tell us what?
The new dollar amounts, the new limits for FHA or VA?
Well, I don't think so.
No.
No, okay. All right, I don't have it here. Did I write it in? No. But there are limitations, and I believe for there are limitations for every single state, and there's limitations per county. I don't know where you guys are from, but for Monmouth County, we are an extremely expensive county. So our limitation, I believe, is $764,000. So anyone looking for a house and wants to get an FHA loan, they can go up to $764,000. After that, it becomes a jumbo loan and it becomes non-conforming because it's beyond that dollar amount. Okay. And the VA is the same thing. The two numbers are usually on the same thing. So again, for Monmouth County, we're the most expensive. If you were to go to Ocean County, let's just say the number would be somewhere around 400,000. That's how drastic the differences are. Okay, so we did the non-conforming. Okay, so the next thing now that we need to know is about the legislation of financing. Okay, what has happened with the financing world for the buyers, okay, or anybody applying for a loan, I guess is the better way. So we have what they call the Truth in Lending Act. We call it TILA, okay, TILA, all right. And then we also have the RESPA, which is the, God, Gloria, where's your brain today? It's the Real Estate Settlement Procedures, RESPA, Real Estate Settlement Procedures Act, okay? So with the Truth in Lending Act, or TILA, okay, came what they call Regulation Z. These things you need to know absolutely for the state exam. These are items that you cannot not know, all right? So Regulation Z is basically requiring the credit institutions, whoever it is that's dealing with money, to let the consumer know the true cost of obtaining credit. All right. And as a result of that, it also allows them to shop the different lenders as far as costs are concerned. So they can compare costs. Okay. This is strictly for residential. It doesn't pertain to business or commercial. What Truth in Lending Act also has done is it has given us the annual percentage rate, meaning what is the true cost of borrowing the money, okay? And most people, the easiest way for me to associate it would be is when you're purchasing a car, you're always being told what the APR is. And that's basically letting you know that all the different costs that go along in borrowing the money, you might start out at a 4%, but really in actuality, you're ending up at a 4.25% because you're adding in all the additional costs to borrow the money, okay? So that's what that is. Then the other item is what is considered a creditor. Who is considered a creditor? It is anybody who's extending credit for more than 25 times a year, meaning payments, okay? Or someone who is using the house, the property as security more than 5 times, okay? So if I'm lending you monies more than 5 times within the year, then I would be considered a creditor. or if I extended you monies for more than 25 times a year, then that's how I would be considered a creditor. So basically, banks are creditors. Okay, there's a 3-day right of rescission. Okay, and you have to notify the lender. And then, but it does not apply to the residential mortgage. Okay, what it does apply is that if, as a borrower, I am talking to a bank, I have 3 days in which I can tell them that I'm going forward with it, or I am not going forward with them. Okay, that's really where that comes down to. They, in turn, if I decide that I am going to go ahead with them, they in turn have 3 days in which to send me what is known as an LE, which is a loan estimate. Okay, and in this loan estimate, it's going to tell me all the costs of borrowing the money to be able to buy this house. What you also need to know for the state exam is it's on page 259. It's called aliens. Okay, so that's the acronym. So it's basically the address of the property, the loan amount, the income, the estimated property value, the name of the borrowers, and the social security number. That is the minimal amount that you need to have to apply for a mortgage. All right, so it's called aliens. The right. Right. Okay, so that's that. Then what has happened is in, I want to say 2010, I don't know the dates exactly, but what happened is TILA, okay, which is Truth in Lending, and the real estate settlement procedures, they got married and they had a baby called TRID, TRID. And that is basically a combination of the two. So what that has done, in addition to what the Truth in Lending and the regulation has done, TRID has now made it that they have to, the 3 days loan estimate, that's what TRID has empowered, I guess is the best way of saying it. So they have to deliver that once it's been agreed upon. The lender must allow at least 7 business days after the disclosure before actually making the loan. So you have 3 business days in which to accept it or not accept it, and then the lender has the 7 days to continue forward. Once the buyer gets the loan estimate, the LE, okay, and again, these are words that you need to know for the state exam as well as for regular life. Okay, so once you get the LE and you decide that you're going to go forward as the buyer, you decide that you're going to go forward with this particular lender, then you're going to have to sign off on that LE and send it back to the lender. And then at that point in time, you're going to get you're going to get what they call a home toolkit. It's explanations about everything in financing, and it's about a ream of paper, and I am not exaggerating. It's about that thick, and that's just part of the process and part of the rules and regulations that came about with TRID. Okay. Right. Okay. So that takes care of TRID as far as this is concerned. Okay. So now the other part that came about is that there with TRID, okay, TILA, RESPA, TRID, all right, came certain things to protect. Again, this is all about protecting the consumer. All right. So in this case here, what they're talking about is triggering terms. Should you decide, or should the mortgage person decide that they want to advertise a particular property with numbers, just like they advertise items like with the car, they have certain disclosures that they have to get, and usually that's like in the commercials where they go, blah, 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 blah. Okay, so that's basically they're trying to comply to the advertising aspect of it, because this also applies to them. It's not just us, or not just the mortgage people. So the trigger terms, whenever you think about a trigger term, anything that has to do with the dollar amount, okay, if you're talking money, that is considered a trigger term. Okay, so you're going to have to disclose things. So if you're on page 260, you can look down here and see what they are. If you're stating, the keyword is stating a percentage or a dollar amount of a down payment, then you're going to need to add additional information to that. If you're going to state the amount of payments, okay, or the time of repayment, or the amount of any payment, or the amount of any finance charge, then you're now, any of those four, you're now going to have to add what's on the next paragraph. You're going to have to say what kind of a down payment, or what kind of percentage, what kind of payments. Is it going to be 360 payments? Is it going to be 300 payments? How long is the term of the loan? Is it 30 years, 15 years, 20 years? And then you're also going to have to state what exactly the annual percentage rate is. That's going to have to be included in there. So the example that they're giving us for full disclosure, okay, is they're saying that there's a 30-year loan available. Okay, the payment is going to be $1,432, which includes principal and interest. Okay, and you only need 5% down. Okay, so if we started out with $1,432, okay, which includes principal and interest, then we would have to say that it's a 5% loan or a 30-year loan. All right. As a realtor, okay, in real life, all right, the key here is we normally do not advertise payments. All right, that is not our job. Our job basically is to show property and sell the property, and then make sure that we bring everybody together and handhold the buyer or the seller, depending what side we're on, and help them along through the transaction. All right. If I'm selling the property, and basically as a seller's agent, I am going to be marketing the property. I don't want to get involved with the dollar amounts. All right. I've stated what the listing price is, and more than that, I do not need to tell them. But if it's, let's just say, a property that's very low, let's say it's a $300,000 property or $275,000 property, and I want to be able to show first-time home buyers that they really are able to afford the property, and I want to show them what the monthly payment is, then I will go ask a mortgage person to draw up a flyer for me, because they know exactly what has to be put onto the flyer, what needs to be in there, and all of that, in order for them and for me to comply with this TRID regulations, or with the consumer regulations. All right. So that's basically real life. All right. But here, as far as the state exam is concerned, you need to know if there's any dollar amounts or anything that pertains to dollar. Those are considered triggering terms, and you need to know what you have to have in there. Now, what is considered non-trigger, okay, is when you're vague, when you're basically vague about it. So if you're going to say, well, there's financing available, right, or the terms are negotiable, or the owner may finance the property, or anything along those lines, those are pretty much vague. They're not making actual statements of the dollar amount. The key at that point is, on anything that you're talking along those lines, you need to make sure that you put and state that it's to a qualified buyer. Even though it's vague, you still have to state that it's based on a qualified buyer. That's the most important part. Okay, so more than anything, that's That's really what you need to know. So if you're offering anything along those lines, saying attractive financing or anything that's vague, terms are negotiable, you always have to add the words to a qualified buyer. And that question does come up on the state exam quite often. So what kind of penalties are there if the lender and you don't comply? All right. Well, for the lender, it's $10,000 each day, not one time. So for every day that they're not compliant, it's $10,000 each day. It's court costs, attorney fees, and any actual damages that have been done. If this is willful violation, that's considered a misdemeanor, okay? And it's $5,000 or 1 year's imprisonment, or it could be both, all right? So those are numbers you do need to remember for the state exam, because the state exam I have found asks for a lot of these penalty fine kind of numbers. All right, now again, granted, this is going to be multiple choice, but you still need to know that what the numbers are, otherwise you're not going to be able to pick the right number. So equal credit opportunity, okay, that basically states that we can't discriminate. And the biggest deal right now, the biggest hot button right now is the dependence on public assistance. Neither you nor I can discriminate against anyone who is getting government subsidies. All right, their credit has to be good, and if their credit is good and they have enough money through government subsidies and or their additional numbers, then we can't discriminate against them about buying a house, okay, or renting a house. This does not just apply to buying a house. This also applies to renting. All right, so that's a very important factor. So we're back to RESPA. Okay, so RESPA is letting everybody know what the actual settlement costs are. Okay, RESPA also is letting everybody know who and how we are involved. So as an example, my company owns a title agency. Okay, so because of RESPA, and title agencies are dollars, right? It's part of the transaction. We have to let our buyers and sellers know that our company is an owner in a title agency. So in our company, we have a piece of paper that states that this agency owns or is a partial owner in this company, blah, 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 blah. We're just letting you know. And then we have the seller or the buyer sign off on that to let them know that we're affiliated with them. Because we have to, bottom line in real estate, no matter how you look at it, it's all about being transparent and full disclosure all the way. Are we good with that?
Yep.
Thanks, Kim.
Moving
Okay.
right along nicely. You are, Gloria.
All right. Thank you. All right. So we're back again with my Tilla and Respa got married and they had TRID. So basically what happened here is they took all of the forms and supposedly, at least this is what the government is telling us, is by merging all of these forms, it's less paperwork. You could have fooled me, but okay, if that's what they're saying, that's what they're saying. So, so again, oh, here we are, 2015. This is when it happened. Okay. So now with TRID, the key to TRID, apart from the fact that the forms are merged, the key to TRID is that they have added limitations. All right. And the limitations are basically on timing. All right. So the key to that is the lenders have to give a lender's estimate, an LE, within 3 days. Okay. They have to deliver documents to the consumer within a specific time frame. Okay. That's the key. That's the most important. The questions that will be asked about a home equity line of credit, does that have to follow TRID? The answer is no. Anything that's a movable dwelling, such as a mobile home, reverse mortgages, or commercial mortgages, that does not apply to TRID. TRID only applies to a residential loan, okay? A residential loan, even though a mobile home is considered residential, that's still comes under the DMV. So the key here is the old forms, what were called the old forms was the GFE, which is a good faith estimate. It is now called an LE, which is the loan estimate. The HUD-1, that's the old form, is now called a CD, which is a closing disclosure or closing document. Okay, so those are the new words that we're using. Okay, the loan estimate, when you're dealing with the buyer in real life, okay, the loan estimate, you tell your buyer to hold on to that, because when it comes time at the closing time and they get the closing disclosure, you want your buyer and you to compare the two. You may or may not be involved in it depending on the kind of relationship you have, but you want them to take a look at the loan estimate versus what the closing document is. And typically the closing document might be a teensy weensy less or just exactly the same. If there's an outrageous difference, then that needs to be discussed, because the TRID law does not has limitations on what they are allowed to do excessively or not excessively. So we talked about, if we're looking at page 262, we're talking about the intent to proceed. Okay, so we got the loan estimate, right? And so now we're letting the bank know that we intend to proceed. So again, we're back to aliens. What do they need? They need the address of the property, the loan amount that they're requesting. They need to know the income, okay, what the value is, their name and their social security number. So now with the loan estimate, it's there, as I mentioned before, you're going to get that document that's basically a ream of paper. It is called the home toolkit. You do need to know that because they are going to ask you that. Again, this is something new, so they're going to ask you about that. And then they're going to talk about what all the costs are in applying for borrowing the money. All right. So again, as I mentioned to you, all of this is going to be in underwriting. So they're going to be asking the borrowers all these additional information. What is their income, their savings, their IRA? If there's money being gifted to them, then they need to get a gift letter. All right. And then the person that's gifting them the letter, or gifting them the money, also needs to be aware that they will also have to prove where that money that they have, that they're gifting, where that came from. A lot of people don't realize that. So that's something that they need to know. In New Jersey, there are no prepayment penalties, okay? Other states may have it, but in New Jersey, the mortgages, if it's done through a regular, institution, not a private individual, there are no prepayment penalties, okay? All right, so now if we're looking at let's see, where am I? I did that already. I did that. Oh, is that the end? Huh, okay. All right, so if we look at the page 264, okay. If we look at page 264, this is considered the loan estimate. This is an actual one. This is not they actually updated this finally. So it's basically showing you at the very top, it shows you the date, it shows you who the people are, the property that they're going after, what the sale price is. In this case, they're talking about a 30-year loan. They're talking what the reason is they're buying it. It's a fixed rate product. They're going for a conventional loan. So they're not going after FHA or VA. They're going for a conventional loan. And then basically it's saying, does this have a rate lock? So what is a rate lock? A rate lock is basically you're going to pay dollars to make sure that the interest rate that you've currently agreed to is going to stay up until the day that you close. Rate locks also have time locks, meaning that it has to be done within a certain amount of time. And if you don't meet that time limit, then you either lose the rate lock or you'll have to pay additional dollars to keep that interest rate. And then as we continue down the line here, it's showing you what the loan amount is, what the interest, what the principal and interest payment is, okay? And then there's, in this case here, they're showing a prepayment penalty, but in New Jersey, there is no prepayment penalty. This is a standard loan because there's no balloon payment. If this was a balloon payment, it would be known as a partially amortized loan. I don't know if Frank taught you that.
He did.
Okay, good. So there you go. So this is a fully amortized loan. And then here they show you what the projected payments are. So again, typically we're talking 1 to 7 years. Okay, if you're, excuse me, if you're under 20%, then you might end up having to pay private mortgage insurance, okay, because private mortgage insurance comes under conventional. And if this was an FHA, it would be what kind of mortgage insurance?
PMI?
No, that's conventional.
Oh, MIP?
Yep, that is correct. Ding, 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 ding.
Thank you.
You're welcome. So it would be MIP if it's FHA, all right? And then they're showing you from year 8 to 30 because they're figuring that the 20% will come in 7 years, not with our market the way it is. But anyway, so then they're showing you that they've taken off the mortgage insurance premium. All right, so it drops, however, it drops $82, all right? And then further down, they're showing you what the taxes, insurance, and any other kind of assessments, all right? And then they're telling you what the estimated closing amount is and what they need to bring cash to close. Now, prior to this, and I can attest to this 100%, prior to this, it used to be you were told, the buyer was told to bring $10,000. That's what their closing costs were. And prior to TRID and RESPA and TILA and all of that, it was no surprise if you went to the closing table and then you're told all of a sudden, oh, no, it's not $10,000, it's $16,000. And now the buyer is scrambling to come up with the additional $6,000, which of course they don't have. So that becomes a very big issue. And that's why when they came out with TILA, RESPA, and the baby TRID, it has really made it better for the consumer because now there are no surprises at the closing table. What you're being told at the close with the closing document, this is what you have to bring. It is actually that dollar amount. And then when you look on 265, it just basically lays out what the actual costs are, okay, and how they came about those dollars, all right? And then on page 268, it's actually showing you what the total interest and mortgage, what the total interest is in 5 years, okay, or how much you will have paid off on the principal. And the key here is they're telling you what the APR interest rate is. So if we looked originally at the, did it tell us? It should have told me. Yes, they told us on page 264 that the interest rate is 3.875. But when you put in all the costs that are necessary, your APR is actually 4.274. So that's what it's costing you to borrow the money. All right. And then it just continues saying, what else do we need to have or what other items need to be considered? So again, the bottom line is it's 3 business days that they have to give you the loan estimate. It has to be within 3 business days. And the closing disclosure also has to be given 3 business days prior to the actual closing date. So typically they give it like a week before, all right, closing date, usually 5 days, 4 days ahead of time, so that this way you need to, the buyer needs to go over it, make sure that everything is there that it's supposed to be, the numbers are correct, the amount is borrowed, that's correct. Were there any kind of credits given? You want to make sure that that's in the statement as well, because if the seller has given you a credit, that has to show up on the closing statement. The commission has to show up on the closing statement. So anything and everything that has to do with the actual transaction, the actual financial transaction, will show up on the actual closing disclosure. It will not show up on the loan estimate, but it will show up on the closing disclosure. All right. So how are we all doing?
Good so far.
Well, Kim, I know
So
you're
far,
there.
so good.
Okay, so how about if we take a 15-minute break? I have 7:22. So how about if we come back at 7:35? Well, 7:40.
Okay,
And then we'll do deeds, which is not that much, and then we'll be done for the evening. Okay,
sounds good.
good. See you in a few.
Thank you, Gloria.
You're welcome. All right. Oh, where is that? Where's chat? What the? Oh, there. Oh, there it is. Hold on. Google Drive. Ah, okay. Connect. How does that work? Allow. Allow. Yeah, that's not working. Okay, it doesn't matter. Okay, is everybody on board?
Yep.
Okay.
Yes.
Hello. All right. So I think I sent you a link in the chat in case you want my little cute little picture here.
Okay.
It just kind of really describes what we're going to be talking about. All right. So deeds. Let's talk about deeds. Okay. So a deed is basically the instrument that's conveying the right to the title to a piece of real estate. So basically what it is it's saying, yes, I am the person that is willfully, voluntarily transferring this property to the new buyer who will become the owner. So that's chapter 19, and it's towards the end of 19 in the book, just so you know. And let me see if I can get to there. It is on page 331. Well, actually, just before that. So 326. Nope, 325 is where it starts. Okay, so page 325 is where it starts. Okay, and so basically it's obviously, as everything in real estate is in writing. There's no doubt about that. It's all in writing. And so in this case here, now, just so you understand, while we're talking about all these documents, whether me or Frank or whoever, okay, a lot of these documents, we don't do anything with them. We don't participate. You just need to know this mostly for the state exam. All right. And the other part of it is most of these documents and everything that we're talking about happens at the closing table. So basically it's the attorneys that write up and do these documents. All right. And most of the signature signing and all of this kind of information is done at the closing table. All right. So while it might seem like it takes a whole bunch of everything, and it seems like we're going to be involved in all of this paperwork, the answer is we are not involved in it. We just need to know and understand it. Now, having said that, we also need to know and understand it in the event that we are having an issue. You know, if there's a problem, we need to be able to try to help out and find the information if there's a problem, or if not, then you know, we know what it is and what the reason is, and we can try to explain it to the different people that whoever it is that we're representing. So
Gloria,
yes,
we did deeds already.
you did deeds.
Yeah,
Yes.
we did them. On December 7th, we did deeds and we had a quiz on that as well.
Well, then how about if we say good night to each other?
That'll do it.
How about if we
I
say,
agree.
is that good enough? All right,
Yes.
so then, now, wait, before you guys get off, okay, tell me, you didn't do chapter 1 and 2 yet.
No.
No, he said he was going to leave it for last.
Okay, so chapter 1 and 2, we will be doing it then on Wednesday.
Okay.
All right,
Okay.
unless you want to start now or you want to go home now. I mean, not that you're not home, but,
Wednesday's fine with me.
Wednesday's fine with
Me
me
too.
too.
all right, you got it. I'll see you, I'll see you all on Wednesday.
See you
6
Thank you,
o'clock.
Gloria.
All right,
Bye.
good night,
Thank you.
Good night.
good night.